Centralized exchange versus decentralized exchange. In the world of cryptocurrency, exchanges are platforms where you can buy, sell, or trade digital assets like Bitcoin, Ethereum, and many others. There are two main types of exchanges: centralized exchanges or CEXs and decentralized exchanges or DEX. Let's break down the key differences between them in simple terms, along with their advantages and disadvantages. Centralized exchanges, CEXs. Centralized exchanges are traditional platforms operated by a central organization or company. Examples include Binance, Coinbase, Kraken, and many others. On a CEX, users create accounts, deposit their funds, and trade through the platform's order book. When you use a CEX, you trust the exchange to hold your funds and execute your trades. The exchange manages the transactions, keeps custody of your funds, and provides services like customer support. Advantages of CEXs. 1. User-friendly. CEX offer easy-to-use interfaces and customer support, which makes them ideal for beginners. 2. High liquidity. They typically have more users, resulting in a high trading volume and liquidity, which means you can buy and sell assets quickly. 3. Additional features. CEX often offer advanced trading features like margin trading, futures, staking, and lending. 4. Fast transactions. Trades are processed quickly since the exchange controls the funds and order book. Disadvantages of CEX. 1. Lack of control. Users do not have control over their funds since they are stored in the exchange's wallets, making them vulnerable to hacks or exchange shutdowns. 2. Privacy concerns. Most CEX require users to complete KYC, Know Your Customer processes, which involve sharing personal information. 3. Regulation and restrictions. CEXs are subject to government regulations, which may restrict users from certain regions or impose trading limits. Decentralized exchanges, DEXs. Decentralized exchanges operate without a central authority or intermediary. Examples include Uniswap, SushiSwap, PancakeSwap, and others. DEX allow users to trade directly with each other using smart contracts on a blockchain, like Ethereum. DEX use smart contracts, which are self-executing contracts with the terms of the agreement directly written into code. When you trade on a DEX, you keep full control over your funds, since transactions occur directly from one user's wallet to another's. Advantages of DEX. 1. Control over funds. Users keep control of their private keys and funds, reducing the risk of hacks and exchange shutdowns. 2. Privacy. Most DEX do not require KYC, so users can trade anonymously. 3. Accessibility. DEX are typically accessible to anyone with a compatible wallet and an internet connection, regardless of location. 4. Wide range of tokens. DEX often list many more tokens, including new and less-known cryptocurrencies, compared to CEXs. Disadvantages of DEXs. 1. User experience. DEX may have more complex interfaces and lack customer support, making them less friendly for beginners. 2. Lower liquidity. Many DEX have lower trading volumes and liquidity, which can result in slippage, price changes in order placement and execution, and difficulty executing large trades. 3. Slower transactions. Since transactions are settled on-chain, they can be slower and more expensive during times of high network congestion. 4. Limited features. DEX offer fewer advanced trading options compared to CEX. Key differences in a nutshell. So, which one should you choose? If you're a beginner, a CEX might be better because of ease of use, customer support, and high liquidity. If you value privacy and control, a DEX would be more suitable, as it allows you to trade without sharing personal information and keep control of your funds. Each type of exchange has its use cases, and often traders use both depending on their specific needs and preferences. Remember, this is not investment advice. Conduct your own research before investing in crypto due to the high risk involved. Thanks for watching. Subscribe for more. The Shortcuts Hub